The Federal Reserve on Wednesday, that is on 22nd March 2023, enacted a quarter percentage point interest rate increase, expressing caution about recent banking crisis in USA and indicating that hikes are nearing to an end. FOMC opted to sustain their crusade against inflation, which is not surprising given recent rhetoric from key Fed officials, especially Fed Chair Jerome Powell. As per Powell, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. After raising the federal funds target rate range to 4.75% to 5%, the Fed's policy statement reflects an abrupt shift. The troubles that suddenly erupted in banking sector 2 weeks ago likely led to the Fed's decision to raise the benchmark rate by a quarter point rather than half point. Silicon Valley Bank and Signature Bank were both brought down indirectly by higher rates. After the fall of the two banks, Credit Suisse was taken over by UBS. After this, another struggling bank, First Republic, has received large deposits from its rivals in a show of support. The Federal Deposit Insurance Corporation and Treasury Department have agreed to insure all deposits at Silicon Valley and Signature Bank, including accounts that exceeded $250,000 limit. The Fed also created a new lending program to ensure that banks can access cash to repay depositors if needed. But the danger and warning of the current situation is that many mid-size and small banks, to conserve capital, will likely to become more cautious in their lending. A tightening of bank credit could in turn reduce business spending on new software, equipment, and buildings. It could make it harder for consumers to obtain auto or other loans. It's a worry that such a slowdown in lending could be enough to tip the economy into recession. Wall Street traders are betting that a weaker economy will force the Fed to start cutting rates this summer. Other major central banks are also seeking to tame high inflation without worsening financial instability. Even with anxieties surrounding the global banking system, for instance, the Bank of England faces pressure to approve straight rate hike, and the European Central Bank saying Europe's banking sector was resilient. Last week raised benchmark rate by a half point to combat inflation of 8.5%. At the same time, the ECB President Christine Lagarde has shifted to an open-ended stance regarding further rate increases. The Federal Reserve is trying mightily to claim inflation by raising interest rates without tipping the US economy into a recession. Navigating this soft landing for the economy is a big challenge because higher rates makes borrowing money more expensive for companies and consumers, which slows down economic activity. Key measures shows that prices are indeed cooling out throughout the US economy, but there is still a long way to go before we see normal levels of inflation. Earlier this month, the Labor Department reported that the consumer price index rose 6% in the 12 months to February. That was down from the 6.4% annual gain in January and well off peak inflation of 9.1% in June 2022. The Fed's preferred ruler of inflation is the Core Personal Consumption Expenditure Price Index, so-called Core PCE. In January, Core PCE was up 4.7% over the prior 12 months, which was actually a notch worse than the December reading of 4.6%. Peak core PCE was 5.3% in June 2022. The Fed considers normal inflation to be when annual core PCE is around 2%. The US labor market has remained healthy, but that is making the Fed's inflation battle very harder. The Labor Department reported that the US economy added 311,000 jobs in February, beating expectations. Wages were up 4.6% and unemployment rate was 3.5% higher, but still very low by historical standards. The Feds do plot depiction of individual members' interest rate expectations suggest that the Fed will not pivot from rate hikes to rate cuts until 2024. The committee projects a 2023 US employment rate of 4.5%, down from 4.6% in December. Fed members dropped their 2023 US gross domestic product growth projection from 0.5% to 0.4%. They also cut their 2024 GDP growth projection from 1.6% to 1.2%. On the inflation front, the Fed's projected 2023 core PCE inflation growth rate climbed from 3.5% to 3.6%. Investors have been concerned in recent months that it will be impossible for the Fed to get inflation under control without triggering a recession. Then, what's next for Fed policy? This is what the whole world is anticipating. Markets are currently pricing in 48.3% chance that the Fed will issue at least one more quarter point rate hike at its next meeting that concludes on May 3rd. However, investors and central bankers have roughly 6 weeks of economic data to monitor between now and then that could have a significant impact on monetary policy. In the near term, investors will be watching for February core PCE reading on March 31st to confirm inflation is still trending lower heading into a second quarter. In addition, the FOMC will release the minutes from its March meeting on April 5th, which could shed further light on what factors committee members have been considering and discussing and weighing in terms of their monetary policy decisions. So it's not at over in terms of hikes in interest rates on the part of Fed as anticipated and expected by the worldwide businessmen, bankers, and economists. It is the expectation that Fed may go for one more quarter point increase before it starts softening the interest rates. This is where I feel we all need to wait for the Fed's policy in terms of the next hike, which in all likelihood may happen in the month of May. Hope the information is useful to you all. Thank you very much for your patient hearing.